Hello and welcome back to The Note. It won't have escaped your attention that there's been a lot of activity in the emerging markets recently. Now, whenever there's turbulence, it creates opportunities. Opportunities to lose money, certainly, but also, if you're careful about it and disciplined, opportunities to make money. Let's try to see today how there might be some opportunities emerging from the emerging market mess. Now, first of all, don't even think of attempting to time this kind of thing. It's just not possible. What we're showing you here as Exhibit A is 5 days in the life of the Turkish lira, starting with the announcement from HSBC that it had a very disappointing flash PMI number for China, and ending just before the Federal Reserve scared people again by announcing that it was going to continue tapering off its quantitative easing bonds purchases. Huge fluctuations in the lira, very difficult to predict. Just don't even try. It's going to hurt. The risk-reward ratio isn't good enough. The second point you have to bear in mind is that you are, in many ways, making a bet about collective psychology, because a lot of emerging markets are relatively small, relatively illiquid, and therefore driven by external flows. We can illustrate that for you with this chart that we've shown you before, showing money flowing from the US into emerging market equity and bond funds. You can see huge flows during the years of QE, a big reverse once the Fed started talking about tapering. Once money starts flowing out like that, it can only have an effect on valuations, and as you can see, it has had an effect on valuations. What we're showing you here is the price to book multiple for the MSCI Emerging Market Index and its World Index, which is basically its developed markets index, over the last 8 years, and you can see that emerging markets actually traded at a premium, very unusually, traded a premium to developed markets for much of this period. That was on the logic that they were growing faster and were a good bet to continue growing faster in the future. Now we are back to the steepest discount in about a decade as people again start talking about the need for a discount because of political risks. Plainly, that means that emerging markets are cheaper than they have been for a long time, but you do need to bear in mind that if outflows continue, they will get cheaper still. You also need to look at exactly what within emerging markets is cheap, why that overall price to book multiple is so low. Now what we're looking at here is a breakdown of the book multiples for different components of the emerging markets index, again produced by MSCI. And you can see that two of the countries with big current account deficits that have actually been causing the most concern, Indonesia and India, actually look very expensive compared to the norm, which is rather disappointing. Turkey and Brazil, arguably the two that are creating the most worry at the moment of the big emerging markets, are similarly not really significantly cheaper than emerging markets as a norm. Why are emerging markets apparently as cheap as they are? Well, in large part that's because of two factors. First of all, Chinese financials, and they're cheap because everybody realizes that there is a risk of a credit bubble there. And secondly, Russia. And again, I think we all know why Russian stocks might be cheap, might be selling at a discount. There is, to put it euphemistically, some concern over corporate governance and political risk when you invest in Russia. So where is true value to be found? Well, one interesting phenomenon that is appealing to a lot of emerging markets investors at the moment is to go to the frontier, countries that are still not developed enough to count as emerging, with much less liquid, much less developed markets. As you can see from this chart that we're showing you here, frontier markets really didn't recover like the emerging markets did after the crisis. They carried on flatlining for a while. They have been improving very steadily over the last few months. They've been making up a lot of ground. They've got some momentum behind them. Quite a lot of the money that might be coming off the table in the countries that people are worried about could be moving into the frontiers. They're in many ways still a less correlated play with the developed markets, and plainly there's an interest there. Another way to try to look for value, I would suggest, is using the logic of the underlying situation that we're seeing here. As a result of the turbulence that we're seeing, two critical things have happened in several emerging markets. First, domestic interest rates have risen as central banks have tried to defend currencies. Secondly, currencies have weakened. Who will this benefit and who will this harm? Well, my suggestion, logically, is that it ought to be good for exporters and bad for companies that are trying to sell things domestically. And that suggests there's an opportunity. If you look at this chart, which again compares different MSCI indices, you can see that consumer discretionary companies, which are largely exposed to the domestic consumer, the growing middle class, which has excited a lot of investors in the West, consumer discretionary stocks have done very, very well. They've far outperformed, whereas capital goods companies, which I'm taking as a decent enough proxy for exporters, have done really very badly indeed, barely up above from the bottom. Now, maybe some of that is down to differences in their performance. Certainly capital goods companies and many other exporters aren't helped by lower commodity prices. But if we now take a look at valuations in those two sectors, you can see that it really is mostly about sentiment and valuation. Capital goods companies were at a strong premium to consumer discretionary companies pre-crisis. Their valuation now is almost still at the rock bottom that it hit during the crisis. That suggests to me, I'm not suggesting to do this on a 1 or 2 or 3 day basis or even a matter of months. On a longer term basis, it does look to me, therefore, as though emerging market exporters look too cheap relative to emerging market consumer discretionary companies. So if you do want to look for opportunities in emerging markets, perhaps there's one there. Logic suggests that you should be looking for companies that aren't too harmed by higher domestic rates and are helped by cheap currencies, and that would mean emerging market exporters.